Kevin Gordon. He's head of macro research and strategy at Charles Schwab. And, I look at this, and as far as I can see with personal finance in distant retirement, the younger crew, which you're arguably the voice on Wall Street, the younger crew takes this a lot more seriously than I did when I was 30 at the Wobbly Barn way up in Vermont.
Yes, it is a definitive shift. I thought that
piece
was fascinating because, I sit at such an interesting nexus. You sort of talk about me being the younger voice on this. All day I'm in the Wall Street world for work, but then I live in the Gen Z world. I'm cuspy, but I'm technically Gen Z still. I'm on the edge of it.
It's a new word.
Older Gen Z, younger millennial.
I'm
exactly.
Cuspy.
Okay.
I'm cuspy.
But this whole idea around, you see it survey after survey, anecdote after anecdote, but younger people today, especially in Gen Z, they just don't really believe in that classic American dream of a house being a wealth generator. So they have shifted a lot to the stock market, but that has really important implications for how they think about saving and how they think about building wealth over time. Not, better or worse than what it was before. It's just a different environment than what we've had.
They think about income generation through these fancy ETFs that cost a lot of money, but also I guess when it works, but it feels like there's a lot of risk-taking involved that they may not be aware of.
Yes, there has been a blurring of this sort of investing versus gambling kind of mindset over the past several years. I would sort of date it back, I guess, to 2021 when a lot of people were treating that meme stock craze as this new way to wealth. But obviously that ended pretty poorly.
I want to interrupt you. This is too important. Your colleague Liz Ann Saunders is leading the way on this.
Yes.
She is the #1 voice in the racket over
gambling
this gambling and what it means for kids. In your milieu, when you're a hipster and you're out on the weekend and all that, how pervasive is the gambling?
Oh, it's incredibly pervasive. I mean, because it's all in front of us all the time. We all see the stats on screen time and how much people are buried in their phones, and it gets larger and larger percentage-wise when you go down the generations.
Do they understand they're losing money? Is anybody making money?
I don't know if the statistics on gambling versus investing are definitive in terms of how much money the average person loses for the former. So investing over the long term is statistically and empirically it's the better way to sort of build wealth. But I think also what has sort of taken hold, and this was sort of embedded, I think, a little bit in the story that you were discussing earlier, is that we have, because of housing being so much at the center of how people view wealth building now, and the fact that housing is frozen for a huge chunk of younger people, out of reach. We have been living in what has been called this little treat economy, where people are treating themselves to smaller things, not necessarily thinking about saving for a big down payment or a big purchase, not painting that across the board for millennials. But that is increasingly becoming the norm and the feeling, and hence why you see also a lot more money being put into the stock market. So again, it's not necessarily an outright bad thing. It's just different in how people are treating their wealth.
I mean, this source of demand for equities kind of continues unabated. If people are treating gambling as investing, when they really want to go to something safe, what is that safe thing?
Well, I would argue that any sort of tried and true and tested asset class, whether it's the bond market, whether it's the stock market, those traditional asset classes have sort of proven their worth over time.
Are millennials investing in bonds?
I wouldn't say that the interest is there yet, especially when I speak to them. I think that that's still maybe a more of a kind of enigma and a little bit of a black box in terms of the dynamics of the bond market.
To us as well.
Oh yeah, I mean, to me, I'm a stock market person, so the bond market to me is still an enigma. But I think when you start to look into the mechanics and the maths of the bond market, especially this week. When I have people now texting me about bonds, that's when things are really getting out into the mainstream and getting very, very interesting. But I still think that from that sort of coupon perspective and that yield perspective, we've been in the camp that the bond backdrop is favorable. Maybe not necessarily out to the long end in the 10-year, but if you're focusing sort of right below duration, which is where our guidance is right now.
I love this. This is brilliant, Kevin, this banner that we've got up now, Young Americans Living in the Treat Economy. That's absolutely brilliant. Let's bring this up, the writings of Kevin Gordon. He's been writing all summer because Liz Ann took the summer off. The S&P 500 up marginally, yet breadth improving, perhaps emphasized most by the fact equal weighted S&P up 8.9%, Mag 7 down the tubes. So we're learning again about rotation and that. Yes. Bring it back to retirement. If I'm in those ugly middle years where I'm thinking about retirement, I'm scared stiff, I won't have enough money, but I'm paralyzed, I can't do anything. 45, 50, 55 years old, what's the path given this new breadth?
Well, the breadth of the market, I think, and what you've learned over the past several years, because we've been in, I would argue, this multi-year rotation process, not necessarily outside of the Mag 7 where those companies just aren't going to be good performers, but we often find that there's this conflating, and you run into this where people think just because they're the largest companies, they're going to be the best performers in the market. That was the case several years ago, but that hasn't been the case in the past several years. So I think that, notably 24, 25, that's when you started to see more of a definitive shift. So the fact that they could still be up this year or up over the past year, that's true, but they're sort of ceding leadership to a lot of other parts of the market that have been asleep for a good chunk of this bull market.
Yeah.
Small caps is sort of the poster child of that. So I think in a rotational market where you've got north of 70% of companies in the S&P 500 that are trading above their 200-day moving average, that is much more consistent with rotational markets where leadership can change over time, and it's not necessarily portending, some massive drop in the market. Very different backdrop than late 2021, which I think is an important analog, because that's when things started to get way too top-heavy. Breadth under the surface was deteriorating, and then you ultimately had the bear market in 22.
I want to go back to what you said about the treat economy and how people are feeling that they want to treat themselves a little bit because the big things are so out of reach. The flip side of that is that phenomenon of FIRE, right? Financial independence and retire early. Invest really aggressively. Deny yourself everything for now so that by, 30 or 40 or 50, you can retire and go live your best life. How much does that come up in your conversations with this generation of investors?
Comes up a lot. I have a lot of discussions with individuals who, whether it's in a friend capacity and they're just letting me know their experience, or if it's at a client event and someone tells me about whether it's themselves or if it's their child or grandchild. I think the concept around labor in the U.S. and how that has changed, how you can have a lot more sources of supplemental income these days. Again, survey after survey showing that younger people think that content creator is sort of rising up the list of potential. For a job and for a full-time job. Not that that's going to be the dominant job. It's not that I'm, predicting that, but that's becoming more of a sort of a sentiment in the U.S. amongst the younger crowd, is that with the FIRE movement, but also having different streams of income, not necessarily relying only on one income stream from one job necessarily.
At 40,000 billion, folks, I speak like the English here. Instead of 40 trillion, it's 40,000 billion. Bring up the debt clock again. On Bloomberg Money today, it's a debt clock hat trick. We brought it up.
How many commas is that?
It's like 40 billion and counting and all that. Do the young kids care about the debt, or is that just, Liz Ann was wonderful on this, and I think the younger Bush administration, do we care about the debt if we're young Turks?
I would say in general, the younger generation, I don't hear about the debt maybe ever. I think that for some of these numbers, whether it's the debt, whether it is some of this issuance in the bond market, whether it is everything related to AI and the investments that you're seeing, some of these numbers are just so large. I think that the mind can't really comprehend them. I was sitting in a strategy meeting this morning, and someone was saying, and I'm going to fudge the numbers and not remember them.
But it doesn't matter because they're big. Numbers.
But someone was saying, a trillion seconds. If you think about it in timing, a trillion seconds is, some decades ago in terms of years. So, you compound that to 40, or you sort of multiply that to 40, and it kind of puts into context how big these numbers are and how we really can't sort of fathom them. So I don't blame people for maybe shying away from wanting to approach that topic, but at the same time, again, we've been living with such large debt piles and large deficits for so long. I think also part of this is it has become a bit of the new norm. Not that I'm endorsing it, but when you have both sides that really don't seemingly want to do anything about it, and it becomes just this norm, that's what happens.
12 seconds. Yeah, is the glass half full or glass half empty right now as you write for the weekend?
Glass half full.
There you go. You can come back. Kevin Gordon, thank you. With Charles Schwab. Can't say enough about that. Thank you for the response and the videos that we get out on the weekend, what Scarlet and I are doing on LinkedIn and Twitter. Really, really, really appreciate that.